going to go through some theory, and the next following videos we're also going to go through some theory in detail. Please make sure that you understand how to buy, when to buy a stock, and when to sell a stock, and when to short a stock, and when to buy it back, because I want you to have that practical thinking when we go over the theory. So in this next couple of videos in the investing theory, we're going to discuss theories related to principles of investments, such as traditional portfolio management, modern portfolio theory, security analysis methods, and portfolio management. We're also going to discuss active and passive investors, efficient market hypothesis, and the risk for investors and their disadvantages. So we can actually start by looking at the modern portfolio theory. So or MPT, whatever you would like to call it. So the MPT promotes the use of variety of securities to maximize the returns. MPT examines the relationships between various securities before drawing risk internal relationships between them. Yeah, it is not possible to achieve success by attempting to obtain all low-risk securities, according to the theory. Yeah, an investor can achieve success when choosing investment channels by combining low-risk securities with high-risk securities. Therefore, risk can be minimized according to the modern theory by diversification. Since this is because diversification can be achieved by owning many shares in companies that operate in various countries, markets, or produce different types of product lines. Yeah? Hope you understand that. Next one. The traditional portfolio management seems to be a non-quantitative approach, and quantitative you should know from the statistics videos I've made. Anyway, so it is balancing the mixture of assets like stocks and bonds for numerous organizations and industries to reduce risk and the total risk of the portfolio, of course. Yeah. The traditional method of estimating the return on an individual security is to look up the number of dividends paid by the firm, which is the price-earning ratios. And you should know what the dividend and the price-earning ratios are from the financial videos I've made. Yeah, so make sure you watch them if you don't understand. Anyways, the average holding period and a guess at the market value of stock. The traditional theory held that risk could be calculated for each security by calculating the standard deviation, which you should learn from the statistic video I made, and the security with the lowest standard deviation should be selected. There are more... Oh, sorry, I forgot to press these buttons. My bad. Here we go. Where were we? There are more risk in securities with higher variability and higher deviation than those with lower variability and lower deviations. Yeah? So learn what standard deviation is and how to calculate it, and come back to this video. Yeah? Let's look at the security analysis. So normally, before an investment is made by investors like you and I, or professionals or experts, and etc., some requirements have to be met. Yeah? And these requirements usually contain fundamental research of economy, which is why you have to look at the micro and the macro videos I've made. So go back and look at those. So research of the economy, industry, and the company, as well as the technical and the random walk theory, as well as the efficient market hypothesis. Yeah. Therefore, when you are valuing shares, the investor must assess the company's potential prospects by considering a variety of internal and external factors. Profit growth in the future, for example, should be scrutinized more closely. Investors should look at which market the company is in and whether the industry is changing to allow an easier assessment of the company's potential profit growth. Yeah? The size of the company, market share, and whether it consistently steals the market share from its rivals are also an essential consideration, and that's critical thinking. Yeah? It is also worth considering the stock's profitability history. If a company profit and sales growth have been consistent, the chances are good that it will continue to be profitable. If a company's return on equity is high and stable, it can indicate that it's well run. Such information is readily available in a company's annual report, which can be usually found directly on a company's website or Yahoo Finance or hitta.se. It depends where you're from. However, there are some constraints, which is the random walk theory, which indicates that stock prices do have the same distribution and are independent variables, which indicates that the future prediction is unfeasible. Moreover, though, it's difficult to beat the market without taking on more risk. Since investors only buy or sell a security after an existing pattern has emerged, it considers technical analysis to be unreliable. Fundamental research, according to the theory, is unreliable due to the often low quality of information obtained and its potential to be misinterpreted. Yeah? And the critics of the theory argue that the stocks do sustain price patterns over time, and that by deliberately choosing entry and exit positions for equity investments, is it possible to outperform the market, may you ask? And my answer to that is that the efficient market hypothesis, the hypothesis that it states that the stock price represents all information, and where the consistent alpha, which you learned from my statistic video, generation is impossible. In the stock market, stocks still trade at fair value, making it difficult for investors to buy undervalued stocks or sell inflated rates. Yeah. As a result, expert stock selection or market timing should be difficult to outperform the overall market, and the only way an investor can earn better returns is to buy riskier investments. And that is what I showed you in the video 2. As you saw, if you would go, let me go back. So if you would have a stock, yeah, that looks something like this. Yeah. And you would buy, let's say here. You bought here. You bought one stock for, let's say the price were $200. Yeah. You buy one stock. Up here it's 210. Yeah, dollars. So you would make from this point all the way up here. If you had one stock, you would earn $10. Yeah. If you have two stocks, you would make $20. Yeah. If you would have 3 stocks, you would make $30. Yeah. But 3 stocks cost 600. So 3 stocks cost So 3 stocks is equal to $600. 2 stocks is equal to $400 if you want to buy it, and 1 stock is equal to $200. So if you want to make a profit of $30 instead of $10, you have to increase the risk and invest more money. Yeah, and I'm gonna leave it at that. I really hope you understand, and because it's pretty detailed. I mean, I can't stress this enough. Please go back and watch my old videos, from the financial accounting to the statistics to the micro and macroeconomics, in order to understand this. Because if you want to be a good investor, you need all the information and education as possible in order for you to be good. Yeah. And some people think, oh, it's only money, like it's based on whatever. But investments, believe it or not, is actually a lot of psychology. I won't go into psychology with you because I'm not a psychology major, but there's a lot of psychology in investing as well. I'll show you right here, for example. So let's say that you bought that. Yeah. So let's say, or let's do like this. Sorry, my bad. So let's say you bought here at, say this is 300 right here. Yeah, and it looks something like this. So it went all the way down. Let's increase this a little bit. Stock went all the way down here, and you bought right here at 300. You saw a decreasing curve, and it was like, oh, it went down from 400. It's down $100. Yeah. So you decide to buy 500 shares at 300. Yeah, that's a lot of money. Let me think how much it is. It is $150,000. Yeah. So you bought here at $150,000, and then it continues to go down, you know, to 200. So you lost $100 per share, right? I don't want to insult your intelligence, but you lost $50,000. What's going on in your mind when you see this stock still decreasing and decreasing? That's psychological. What are you going to do? Are you going to buy more? Are you going to stress? Are you going to sell it at stress? Or are you going to follow your technique and your calculations and that kind of stuff? And that's the reason why stocks, when you're buying stocks or investing, it's a lot of psychology in. But unfortunately, I don't know. I do know, but I don't think that I'm appropriate person to talk about psychology with you guys when it comes to investing and that kind of stuff. But psychology has a big role when it comes to investing, you know. But I'm gonna leave it at that, and I'll see you in the next video. I hope you learned something today, and I wish you good health. And remember to subscribe and everything. Yeah. Okay.